Hello, this is Alex Birge. As part of the Hospitality 310 class at Missouri State, we're doing a capital budgeting simulation, and I'm going to explain to you today how I got ending APV, or adjusted present value, of a little over 34,000 from 2009 to 2014. I'll start by explaining these numbers a little bit. We started at a revenue of about 245 and three quarters in 2009. In 2014, we raised revenue to 391.1 roughly. Same with operating income. We more than doubled operating income in the course of 2009 and 2014. And again, with net income, doubling net income from 13.5 to 27.86. So I'm going to explain to you how to do that, what I looked at on my income statements, my balance sheets, cash flow statement, and adjusting um, the numbers a little bit to make the best investment. We'll start by talking about revenue by division. The retail division in the New Heritage Doll Company is making more revenue, almost double than the second highest production in revenue by division. We'll explain operating profit. The profit is mainly because of licensing is a less of an upfront cost. Licensing is going to be higher than production and retail that have upfront costs and investment costs, such as property or patents and all that stuff. And then again, looks like production actually has a higher amount of assets than closely followed behind that is retail. So we're going to go into income statement, and I'll explain what you want to look for when you're making these decisions, and what these numbers mean a little bit. We'll start out by net sales. We'll look at these net sales represent good numbers. It looks like in 2014 you're almost at 400, but you're gonna take a slight decrease for a couple years here. It's probably paying off things, or the investment isn't coming into place yet. But as you get to 2018, you're gonna get back to that profit, steadily increase all the way up for years to come. So that's good. You're gonna want to look at your net income. Again, as I was explaining before, first year it looks like after 2014 you're going to take a very small hit, a little bit in net income, but then from years you're going to increase. So again, looks like 2018 you're going to take a little bit of hit in income and then steadily increase all the way through. You want to make sure that this number is increasing because you want to grow your business. The balance sheet, let's look at net assets. We're looking at a steady increase all the way across the board from 2014 to 2024. So that looks like a solid line for net assets. We'll explain, and then of course total liabilities and shareholders' equity is going to equal your net assets because of the general accepted accounting principles. We'll go into cash flow statement. So the first number that you want to look at is your total cash flows. You want your cash flows to be steadily increasing, which they are. It looks like we're going to raise by about 60%. Excuse me. We're going to increase cash flows by about 50% over the course of 10 years. So that's a good line. You're going to want your cash flow operations to be higher than your investment and financing. Your operations is what is running the business. So if you're making more investments in financing than what the money that you're making in the business, then you're going to be in trouble. Looks like the operations are steadily increasing throughout the years, so that is signs of growth in the company and positive outcomes for years to come. The investments, it's negative, but that is a good thing because that means that we're able to pay off those investments and increase our business. Same with financing. It's negative and it's increasing, but the ending cash balance is taking a hit again in 2015, but increasing all the way throughout the next 10 years. So, in order to make these decisions, I've looked at the income and income statements and balance sheets, cash flow statements to see where we're at and where we're projected to be. I look at the project details here, and I'll give you an example. I won't go through all the investments that I made, but an example of an investment that I made in looks like 2009. I made an investment for the toddler doll accessory line. Um, it has a great net present value. Your internal rate of return is looking great. I adjusted the project discount rate to increase my adjusted present value. The payback period is 8.7 years, and that's not great, but it's not going to hurt your company too bad. Your profitability index is fantastic. You have about 190 profitability index. I'd say anything over about 25 is incredible. So let's look at these statements. These are, looks like actuals, so what actually happened in this investment. This is the first time I've looked at this actually, so let's look at this. The income statement, your net income in 2010 from this investment looks like it was negative. That's not a good sign, but then it steadily increased over the course of the next 4 years to a positive net income. So that's a good investment. You're wanting your working capital to increase as well, and your net assets are increasing. So that shows signs that this is a good investment for years to come. Your cash flow statements, a hit in your total cash flows in 2010, but then it has steadily increased ever since and shows the signs of being a good investment for New Heritage. As represented in your operations, it looks like it took a hit the first couple years, but then it continued to grow and make more profit, or more cash flows. Your investments, it looks like a very large investment in the first year, but then throughout it's decreased to a more attainable amount. Your financing right here, the first 3 years, you want this number to be negative. So this first few years have been rough for this investment, but it still looks like that your ending cash balance, you're going to be okay. The first year, we didn't make any money, but it has steadily increased, and this investment has proved to be profitable investment for this organization. So this was a low risk investment. See what it cost. I don't know how much this costs, but oh, there we go. It costs 3.14. So that's good. It's not too expensive. It's a low risk investment. This is a safe investment for New Heritage to make. Um, this investment looks like it'll develop new line of accessories for existing New Heritage doll lines. So there may be that initial um, investment project cost in the first couple years, but then after that research and development and products have been developed, then sales are going to increase and the investment will prove profitable, looks like. We'll go to another type of investment. So that is a production investment. So let's look at a retail investment. So this is a high risk investment that I made in 2012. The project costs of this investment are little to none. You're only spending 0.18. Although this is a high investment, or a high risk investment, you're not spending a lot of money. So that helps in making that decision. The net present value is about 8.15. That's good. Your internal rate of return is out of this world. You love this number. And again, I adjusted the discount rate to work with these numbers a little bit and increase my adjusted present value. Your payback period is only 2, so that is less of a payback period than our previous investment that costs more money. Your profitability index is, again, fantastic. 362 is way more than you need to make a decision on an investment. But you still want to look at the numbers, so let's look at your projected numbers and why I made this investment. So I made this investment because it shows a steady increase in net income for years to come, at a pretty heavy rate. I mean, you got about 0.3 each year, but then it's gaining momentum and getting up to about 0.5 each year. I looked at that, the net income. I also looked at your working capital is increasing every year. Your net assets are increasing every year. Your cash flows are increasing every year. Again, relative to the project costs, only spending 0.18 and having your net assets and your cash flows increase by, looks like 0.15 in the first year and 0.18 in the second year, and then 0.22 in the third year. So you're proving that your cash flows are a worthy investment, being higher than your initial project cost. So that's great. You're wanting your cash flows from operations, again, like I've talked about before in my other investments. You're wanting this number to be positive so that you can run your business. Investments, it's okay to be negative. It looks like this investment, there was no money invested each year, so that is neither positive nor negative. It's kind of a neutral thing. financing negative, which is a good thing in this investment. Ending cash balance, again, increasing every year at a steady pace. So this proves to be a good investment. Let's look at what it actually did compared to. It looks like I only had this investment for about 2 years. Net income actually decreased. So this may not have been a profitable investment for New Heritage. Yeah, it doesn't look like I made any money off this investment. I think that it's important to weigh that I didn't make money off this investment on these as these numbers show, um, but I didn't lose money either. So it is important to look at maybe there were advantages in making this investment that could show up in the future down the line, even if it doesn't show up on these numbers per se. It looks to expand the fan club, so that's increasing the amount of customers, potential customers that um, were maybe possibly to go buy your other doll products because they started their relationship with the company online. Um, and it looks like people can virtually meet so they can tell their friends about it. Um, so this is marketed toward girls, and then it also looks like that when you win prizes in virtual dollars, you can exchange those prizes for coupons or looks like dollar credits to catalog merchandise. So again, this investment may not make money on these financials, but this investment could have produced money in another sector of our business. Although this was a high risk project for New Heritage, I went to this. Um, I went with this investment because it costs very little money. So we've done a production and a retail. So let's try to find a licensing. So here we go. Oh, perfect. There's a medium risk investment we can look at. So this is a licensing investment. Again, I adjusted my project discount rate to get a higher adjusted present value as the years to come. So let's look at what this investment is. The licensing division is proposing a third licensing deal with the studio, which previously signed 2 movie deals. The proposed new film features an established New Heritage doll character and is aimed at the tween market. So, as we read in the overview of the company to prepare for this, the tween market is good investment. This is who we're wanting to aim our product marketing our product to. So aiming this movie at a tween market for girls is a positive. In some respects, it resembles previous films, which actually lost money in their theatrical runs, but did well in DVD sales. The significant differences with this film is that it was produced in a lower budget and distributed only on DVD. So even though that we lost money in previous films that were closely resembled this film, it did well in the DVD sales. So we're just going to stick with distributing it only on DVD because in the past that is how we've made our profit after experiencing the loss from the theatrical runs. We shouldn't make that mistake again. It would not be shown in movie theaters, as it was saying, which was expected to yield significant savings, as I was talking about. It's co-marketed by the studio in print and in DVD ads by the New Heritage Doll in retail and internet outlets. The proposal requires NH to commit to a New Heritage to commit to an agreed dollar amount of marketing support. This project is considered medium risk. So as we read this, let's look at the numbers. This could be a good investment. This could be a bad investment for New Heritage. it's a medium risk investment. So the project cost is 3.5, which that's not terribly low, not terribly high. I believe we had a maximum amount of, I think, 9 in this scenario. So if I'm correct, that would be a 30% of your entire investment would be in this one project. So that it could be a risk like we were talking about. So let's look at the NPV. NPV is about 10.7. That's good NPV that you're wanting, but the internal rate of return 238.61. That is, like we talked about before, that number is incredible. Yeah, like I said, I adjusted the discount rate, and the payback period is only 1.4 years, so that's good. Profitability index isn't as high as the other ones have been, but it's still at a solid number. So let's go to the financials. And I'm going to go through this one a little quicker than the previous ones because I've already explained these numbers a little bit. But in this investment, in the net income, the first year, you're not going to make any money, and then you're going to actually go in the hole into negative income. So you're losing money the year after that. So it's a pretty risky investment if you don't turn around real fast in 2013. But luckily, New Heritage Stall did in fact turn it around and prove to be profitable. So let's look at your net assets. Again, first couple years, same with working capital. It stayed the same. You're not losing, you're not gaining, or so. But then you increase and you are gaining working capital and net assets. So if I could see trends down the line here, it would probably go up for the first maybe another year or so. But as we've seen in the film industry before, especially just DVD, there will be a drop off, and this investment will not continue to make money for your company years and years down the line. But like I said, it could grow your consumer market, and that is a number that does not show up on these sheets, on these details. So the cash flow statement, like we've looked at before, it's the same as your net income. So it's looking good. Cash flow from operations, you take a pretty large hit in the first couple years, but then you get about 4 out of your operations. So that is great, given that your investments in financing, you're able to run this business while paying it off. Your ending cash balance first couple years is not going to do anything. You're going to be investing in the cost of the film and marketing the film, but once that cost is done, then sales will just accumulate, not having to worry about that decrease in income, in net income. So your cash balance will prove to be profitable. Like I said, maybe another year, maybe 2 years, and this investment will kind of die out. So let's look at another quickly here. As represented by the first page on the dashboard, looks like from 2009 to 2014, I doubled my net income. I increased my net sales from 245 and 3/4 to 391.1. So that is a good number. Net assets are increasing every year. That shows company growth, and so let's look at how these all the investments, um, the updates of all the investments throughout the years. Each year you make a selection of your investment, and then you choose, depending on each year, you see the update of how that investment did of each year, and then you go into the next year and choose investments and see how that did and things like that. So in 2009, I decided to invest in a new accessory doll line, which we talked about is a low investment retail store expansion in the Northeast that gives us more revenue than expected, and we're profitable right away. So that's gaining consumer in the Northeast. As long as the cost didn't cost too much, then I feel like expansion of a business, if it proves on the sheets and expected income statements and cash flows, then it should be a good investment to make. So I also decided to replace the equipment to it said, and as well as develop a new software system. And these investments aren't going to be profitable. They're going to be investments that you're going to lose money. You're gonna, but you're going to improve your future software systems, and you're going to have assembly equipment that will lead to less faults in products. So it'll save money down the line, even though it's not represented on your cash flows um, to in a very positive manner. So yeah, this simulation has really proven um, what it takes to grow a company, and has taught me many things that I'm going to carry into my future career. Um, and I hope that this video has been helpful in your knowledge of making investments. Have a great day.